Alright guys, so let's talk about the financial decoupling between the US and China. Now the headlines we see today are all about the trade war, but the biggest battle is being fought in the financial sector. Now it's true that Wall Street today has the advantage versus China, but what is happening right now is going to change the game forever. Now 3 months back, Donald Trump threatened to pull away US investment money into China. And if this was 5 or 10 years ago, it would be devastating to Chinese financial markets. But we are in a very different era now. And let's not forget that the US is waging a costly trade war at the exact same time. And all this is destabilizing the demand for US assets. In 2025, the market is bracing for $2.5 trillion worth of US bonds to be issued. Now, this is at a time where Trump wants to cut imports from the world, making the dollar less useful. He's breaking apart the old model where exporters earn dollars and eventually recycle them back into American assets, and it's a big reason why bond yields have been heading up. Now, Besson is issuing a tsunami of debt which will overwhelm investor demand for US paper. Now, no one has any idea how bad the tariffs will get, and if it goes any higher when yields are already above 5% on the 30-year, demand it will just crater even further. And if you think the fiscal situation can't get any worse, well, it absolutely can. Everything coming out from the White House is from the upside down world.
Is the president okay with this bill adding to the deficit?
This bill does not add to the deficit. In fact, according to the Council of Economic Advisors, this bill will save $1.6 trillion. And the president absolutely understands and hears the concerns of fiscal conservatives and of Americans who want to get our fiscal house in order. That's what the intention of this bill is. There's $1.6 trillion worth of savings in this bill. That's the largest savings for any legislation that has ever passed Capitol Hill in our nation's history. The next bill that even comes close was $800 billion. That's less than half of the savings that we see in the One Big Beautiful Bill. And so
Now, experts are saying the bill will add at least $3 trillion to the deficit over the next 10 years, but she said it will save $1.6 trillion. So I guess all the economists are wrong and should be fired. But the bond markets are not sharing her optimism. Investors just don't want to hold US debt for an extended period of time. Now, the average duration of US debt held today is less than 6 years. That's the lowest of most Western economies. Why is this happening? Because Trump is making the fiscal crisis worse and bondholders expect inflation or the collapsing dollar to be a persistent problem. They are letting money buying shorter term bonds to mature faster if things get sketchy. And this presents a big problem for Besson. He needs countries to buy longer term debt or borrowing costs in the real economy goes up. But it's just not happening. And now this bombshell from China is going to ramp up the competition for international money. Its IPO market is just flying to the moon. Now, IPOs are simple to understand. A new company lists on a stock exchange and people invest in it. And the more IPOs happen in a particular exchange, the more money flows there. Now, China's CATL, the battery giant, just IPO'd. It's the biggest listing of 2025, and the company raised a ton of money. Despite being blacklisted by the Pentagon, they brought in $4.6 billion, over 10% more than all the expectations. And investors who bought the company quickly realized a big profit. On Tuesday alone, the shares climbed by 16%. And that's a big success that helps not just the company, but the Hong Kong financial market as a whole. Capital flows is a zero-sum game. If investor funds head to the Chinese market, it's money not going to Wall Street. And every dollar invested in CATL is capital not allocated to US Treasury bonds. And as more Chinese companies get listed, Beijing competes with Washington for the world's capital. Now, this is serious because the US needs money to flow in constantly. The US economy is heavily financialized, and this is the result of 20 to 30 years of fiscal deficits. It encouraged the world to buy up US assets, and as this reverses, so does the fortunes of the US. If money leaves the US, it creates three big problems. US stocks, which the majority of households invest in, could start to collapse or at least stagnate. And this creates the reverse wealth effect. People start to feel poorer, so they spend less. And if your portfolio collapses in half, you'll be eating bread and water, not steak and wine. Secondly, bond yields will stay high. Everything, including mortgages and business loans, in the US is pegged to the 10-year. and the yield is rising higher despite a tariff pause. Lastly, it keeps the dollar weak. Money flowing out of US assets lowers demand for the reserve currency. As a result, import costs rise for consumers and the industries as well. There are really major markets competing for capital around the world. Now, the gold market is a great example. The price of gold rising is a headache for Besant. So he's trying his best to hide the US fiscal situation. And this time, he's trying to pass the tax bill as deflationary. And the statements like this, they just confuses the hell out of investors.
People are saying tax increases are inflationary, that when I was testifying before Congress last week, one of the congressmen said that, and I said, well, Congressman, if taxes are inflationary, let's cut taxes. So let's get this tax bill done, bring down taxes, which, according to this line of thinking, should be disinflationary.
But let's give Besant props for that word salad. Yes, a tax cut sounds deflationary, but he forgot to mention that the burden is transferred to the US national debt. There's simply no free lunch. The tariffs are also going to nullify the tax cut. Is there a point when US households save $5,000 a year, but tariffs will cost them $5,000 or even $6,000 or more? Well, you can't trick the bond market here. There's a clear reason why the term premium is rising higher, especially after Trump began his trade war on planet Earth. Investors don't believe the king of the world will get the deficits in order, so they are demanding a higher return of nearly 0.7% to hold longer dated bonds like the 10-year. Obviously, this is a big problem, but China's success in the financial market is going to make it worse, and this is where their industrial dominance is lending real credence to their stock IPOs. Now, people are investing in companies like CATL because they believe it can expand. China's overall strategy today is to globalize the world, while the US is turning inwards, and the former strategy has more growth potential for investors. Now, setting up a business is one of the most impactful things you can do in life. It gives you unlimited upside and allows you to challenge the limits. However, before you set up a company, are you doing it in the best location possible? We live in a chaotic world where the global rules keep changing. What you truly need is stability, a country where you have enormous benefits, while knowing this won't change for decades to come. Starting a business remotely in Singapore and Hong Kong is one of the best decisions you can make. And with Osome incorporation in these tax-friendly regions has never been easier. Enjoy the benefits of doing business in these metropolitan cities with the tax advantages wherever you are in the world. The process is hassle-free and completely paperless. Osome will handle your financial administration, taxes, bookkeeping, and accounting. Best of all, with Osome's easy-to-use platform, you can track your cash flow in real time and stay on top of all those invoices. It's time to manage all your business finances in one place. No need for multiple apps or tools. Focus on delivering value to your customers and creating new products. So free up your time and get your business off the ground in Singapore and Hong Kong with Osome. Get started today and build a business that really matters. Incorporating in Hong Kong or Singapore, click the link in the description or pinned comment below for 16% off any Osome services. Let's start your business journey today. Now, CATL supplies batteries to the biggest auto companies in the world. Despite the narrative, Tesla, Mercedes, and Ford are all customers. CATL has 38% of the entire EV battery market. That's terrifying and shows incredible market dominance. The EV market is only going to grow. Plus, companies in China, they have an incredible advantage over their American counterparts. The cost of borrowing money in the Hong Kong markets is dirt cheap. It's at a crazy 0.5%, and this allows cheap money for investors to buy Chinese equities. You definitely can't borrow at 0.5% in Wall Street. Meanwhile, local companies also enjoy the benefits of just manufacturing in China. And this is where the world's most efficient and cost-effective supply chains are located. It's why Chinese companies' share of overseas sales are growing. Now, despite Trump's trade war in 2018, Chinese brands are selling more overseas. This has grown from 9% to 10.7% in just 3 to 4 years. This is a very different situation from the US economy and financial markets. In America, Wall Street tends to lead industries, but in China, it's the other way around. The strength of the Chinese economy is lending strength to their stock market and local assets. It's a very different concept to the West, but it's actually the right way to do things, at least in my humble opinion. So is this the end of the nightmare for US assets? Not just yet. By now, everyone is aware of Moody's credit downgrade on the US economy. US debt lost their final AAA rating, and this is a big stain on the US markets being exceptional. Even Microsoft, the company, has a higher credit rating than the US government. And that's just crazy considering the Fed has the printing press. But beyond just the US, there are ripple effects that spread to global markets. The downgrade is now going to affect foreign investment funds that hold US bonds. And this time it's Hong Kong that's sounding the alarm. Pension fund managers are flagging a real risk of being forced to sell their treasury holdings. And it all ties to the downgrade, showing that there's a real material effect from Moody's re-rating in the real world. Besson has gone on a record saying, who cares? Qatar doesn't, Saudi doesn't, the UAE doesn't. But investment funds in Hong Kong care, and very soon the rest of the world will. This is one of the world's top tier financial hubs. Now, Hong Kong has very strict investment mandates. Many funds are allowed to only invest 10% of assets in treasuries only if the US has a AAA rating. And the ratings must come from big agencies like Fitch or Moody's. And now that the rating have been lost, there's a chance these funds have to divest their holdings. In other words, dump the US government debt to buy something else. There are people asking Hong Kong to relax these mandates, but what if they don't? What if they enforce the standards? We are in uncharted waters. Never before has the world reserve currency issuer lost AAA status across the board. So how big is the exposure? Well, as of end 2024, this could stand at almost half a trillion Hong Kong dollars worth. In USD terms, that's around $63 billion. Data also shows Hong Kong only holds 2.3% of total US bonds outstanding. But the problem isn't just the absolute value. What if smaller rating agencies continue to downgrade the US debt market? If funds in other countries decide to tighten their standards, we could be in store for a bigger selling wave, and this situation is frankly not impossible. We are beyond that point by now. Every day is a Twilight Zone moment. Trump is rewriting the rules every morning when he wakes up. And here's another magical moment for you.
I'm a fiscal hawk. I'm a bigger fiscal hawk. There's nobody like me as a fiscal hawk.
Massey said that has more deficit than Biden did, and this bill kind of...
Because we have to fix the country.
Do you think that Thomas Massey is correct in saying that this is adding Biden level
No, I don't think Thomas Massey understands government.
And look, if you can take the US economy seriously today, I really salute you, because it's just a comedy show at this point. I don't even think Trump knows what a fiscal hawk is. He's the biggest fiscal daft. He's the king of spending money. Calling him a hawk is like a chef who hates to cook. It's downright ridiculous, and that's why the bond market is in shambles today. But let's get a little serious here. Unless the US gets their fiscal house in order, more agencies will drop their ratings, and more funds will consider dumping their bond holdings. Ray Dalio also made an important post. Credit ratings understate the real risk. They only capture the risk of default of the government not paying their debt. But the real risk is in the printing of money to pay their debt obligations. It's defaulting through inflating the debt away. So bondholders are facing losses not from the nominal value, but from the real value of money. If Dalio can see the obvious, you can bet many professional and retail investors are also bracing for impact. This is why the US debt situation is reaching critical levels. It doesn't just increase the risk of default, it also allows other financial markets to catch up with Wall Street. It's just like the semiconductor war. China might be behind today, but the US is scoring so many own goals, it's quite impossible not to score a win. As more money flows to Hong Kong, it won't be good news for the dollar as well. It's a form of de-dollarization, and let's ultimately not forget that. But let me know what you think. Can Hong Kong catch up? And will Trump ever take the deficit seriously? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.